What if you knew exactly when the market was going to move and exactly where to enter? Most traders use one or the other. Seasonal analysis tells you the direction and the timing. Smart money concepts tell you the precise entry. Today, we're going to combine both into one powerful strategy that almost nobody is talking about. This is seasonal analysis plus smart money concepts. The ultimate trading edge. Let's start with the problem. If you're a seasonal trader, you know when assets tend to move. For example, the S&P 500 is historically bullish in November, with an 87% win rate over the past 15 years and an average return of 3.1%. That's incredible timing data. But knowing November is bullish doesn't tell you where to enter. Do you buy on November 1st? Do you wait for a dip? What's your stop loss? On the other hand, if you're an SMC trader, you have precise tools for entries. Order blocks, fair value gaps, liquidity sweeps. You can find exact price levels where smart money is likely to enter. But you might take a perfect SMC entry in September, the worst month of the year, and wonder why your trade failed. The truth is, neither approach alone gives you the full picture. Here's the key insight. Seasonal analysis works on the macro time frame, weeks and months. It tells you the direction and the probability. Smart money concepts work on the micro time frame, the 4-hour, 1-hour, and 15-minute charts. They tell you the exact entry and exit. When you combine both, you get the direction from seasonality and the precision from smart money. It's like having a weather forecast that says it will rain this week, combined with a radar that shows you exactly when and where the storm will hit. Let me show you how this works in practice. Let's take November 2024 as our example. On C's Optima, we can see that the S&P 500 has been bullish in November 87% of the time over the past 15 years. The average return is plus 3.1%. The seasonal bias is clearly bullish. This is our macro direction. We know we want to be long during November. Now, let's zoom into the chart. In early November 2024, the S&P 500 pulled back after the election volatility. Here's where smart money concepts come in. On the 4-hour chart, we can identify key levels. First, we look for a liquidity sweep. Price swept below the equal lows from late October, taking out stop losses. This is classic smart money behavior. They push price down to collect liquidity before moving it higher. Next, we identify an order block, the last bearish candle before a strong bullish move. This is where institutions place their buy orders. The order block sits right at a discount level, below the 50% Fibonacci retracement. Finally, we look for a fair value gap, an imbalance in price where the market moved so fast it left a gap. This gap acts as a magnet for price to return and fill before continuing. The trade setup is elegant. The seasonal analysis from C's Optima tells us November is bullish with 87% probability. The SMC analysis gives us a precise entry at the order block inside the fair value gap after a liquidity sweep. Our stop loss goes below the order block. Our take profit targets the previous high, which seasonal data suggests will likely be reached given November's average 3.1% return. Here's why this combination is so powerful. The seasonal edge gives you confidence in the direction. You're not just hoping the trade works. You have decades of data saying this is a high probability period. The SMC edge gives you a precise entry, which dramatically improves your risk to reward ratio. Instead of entering blind on November 1st, you wait for smart money to show their hand and you enter with them. And the stop loss is logical, not arbitrary. It's placed below the order block where institutional buying occurred. If that level breaks, the seasonal thesis is invalidated. Let me give you the step-by-step framework. Step 1. Check the season. Go to C's Optima and look at the current seasonal bias. Is it bullish or bearish? What's the win rate? Anything above 65% is worth trading. Step 2. Wait for the setup. Don't enter immediately. Wait for price to pull back into a discount zone. Let smart money collect liquidity first. Step 3. Identify SMC levels. Look for order blocks at discount, fair value gaps that need filling, and liquidity sweeps that signal institutional activity. Step 4. Enter with confluence. Your entry should have at least 2 confirmations. The seasonal bias supporting your direction, plus an SMC setup at a key price level. Step 5. Manage the trade. Set your stop below the order block. Your first target is the previous swing high or low. Let the seasonal trend carry the rest. The beauty of this approach is that it works across all markets. Forex, commodities, crypto, indices. Wherever there's seasonal data and price action, you can apply this framework. And you don't need to watch charts all day. Check the seasonal outlook on Seize Optima. Set alerts for key price levels and wait for your setup. Ready to start combining these two powerful approaches? Visit seizeoptima.com and create your free account. You'll get seasonal data for the S&P 500, gold, oil, Bitcoin, and Eurodollar for free. Use the seasonal direction as your compass and smart money concepts as your entry tool. Subscribe for more episodes where we'll dive deeper into specific trade setups using this framework. Thanks for watching and happy trading.